You've probably heard that a 401k is one of the best ways to save for retirement. Your employer offers it. You get a tax break. Your money grows without being taxed along the way. It sounds perfect. But here's what nobody tells you. You're likely paying hidden fees that are quietly eating away at your retirement savings. And most workers don't even know it's happening. Let me be direct. A 401k is an employer-sponsored retirement account. When you contribute money, it comes out before taxes, which means your taxable income goes down. That's the tax advantage everyone talks about. Your money sits in investment funds, and theoretically, it grows over time. When you retire, you can withdraw it, and only then do you pay taxes on it. On the surface, this seems like a win, but there's a massive problem that the financial industry doesn't want you to understand. Inside that 401k, you're being charged fees. Not just one fee, multiple fees layered on top of each other, hidden in places you probably haven't even looked. These aren't obvious like a bank charge on your statement. They're embedded in the fund expenses. They're buried in administrative costs. They're part of what's called the expense ratio. Here's the reality. In 2026, surveys show that 41% of workers don't actually know they're paying these fees at all. 4 in 10 people saving for retirement have no idea money is being taken out every single year. If that's shocking to you, keep listening, because it gets worse. Let's talk about what these fees actually do to your money. Imagine you invest $10,000 into your 401k at age 30. You plan to retire at 65. That's 35 years of growth ahead. Now, let's say your investment grows at 7% per year on average. Without any fees, that $10,000 would grow to more than $132,000 by the time you retire. That's the power of compound growth over decades. But what if your 401k charges you a 1% annual fee? That seems small, right? 1%. But here's the thing about compound fees. They compound just like your returns do, except in the opposite direction. That 1% fee doesn't just take 1% from your final balance. It actually cuts your total savings by about 28% over those 35 years. That $10,000 that should have become $132,000 is now only about $95,000. You just lost $37,000 to fees. Think about that number. $37,000. That's not hypothetical money. That's your retirement. That's years you could have spent traveling, or with family, or simply not working. And it's gone, because of a fee you probably didn't even know you were paying. Now, I want to be clear about something. Fees vary. Some 401k plans are better than others. Some employers offer plans with genuinely low-cost index funds. The average expense ratio in employer plans ranges from about 0.5% to 2% or higher. For actively managed funds, it can be even worse. But even at the lower end, those fees add up to stunning amounts over time. Here's another angle to consider. Your employer probably didn't choose your 401k plan based on what's best for your retirement. They chose it based on what was easiest to administer, or what gave them the best deal, or sometimes because the provider offered them revenue-sharing arrangements. You might think your company is looking out for you, but the incentive structure is completely misaligned with your interests. Many 401k providers offer what's called revenue sharing. That means the fund company pays your employer a percentage of the assets under management. Your employer gets paid based on how much money sits in the plan. This creates a perverse incentive. They want your money to stay in expensive, actively managed funds, because those generate more revenue sharing. They don't necessarily want you in cheap index funds that would benefit you more. Your employer's financial interests and your retirement interests are not the same thing. Let's go deeper into where these fees hide. First, there's the expense ratio. Every mutual fund or index fund in your 401k charges an expense ratio. This is the percentage of your assets that gets deducted each year to cover the fund's operating costs. For an actively managed fund, this might be 1%, 1.5%, or even 2%. For an index fund, it might be 0.03%. The difference sounds tiny, but over 35 years, it's the difference between retiring comfortably and working part-time in your 70s. Second, there are administrative fees. Your 401k plan needs to be administered. Someone has to process your contributions. Someone has to send you statements. Someone has to maintain the plan's compliance with federal regulations. These costs exist, and they're legitimate. But they should be transparent and reasonable. Unfortunately, many plans bury these fees in ways you'll never see. Some plans charge per participant fees. Some charge a percentage of assets. Some do a combination. Third, there are investment advisory fees if your plan offers a managed account service or robo-advisor option. If someone or something is actively managing your money, that service costs money. Sometimes these fees are reasonable. Sometimes they're absolutely outrageous. You might be paying 0.5% or more just for someone to shuffle money around in a way that doesn't even beat the market. Fourth, some plans offer funds that have built-in sales charges called loads. These are commissions paid to financial advisors or brokers. You might not see a load deducted as a separate line item, but it's baked into the fund's pricing. Class A shares have front-end loads. Class B shares have back-end loads. Class C shares have ongoing loads. These are all ways of saying the same thing. The financial industry is taking a cut before your money even starts working for you. The worst part? This is all completely legal. The financial industry has structured the entire system so that charging you high fees while obscuring those fees is perfectly acceptable. You agreed to it when you signed up. You just didn't realize what you were agreeing to. Now, let me ask you something. Are these fees paying for something that actually helps you? Are your expensive actively managed funds beating the market? The data says no. Year after year, study after study shows that most actively managed funds underperform simple index funds. Yet they charge 2 to 3 times as much. You're paying premium prices for worse results. This is the core of the 401k fallacy. The system is designed to make you think you're saving for retirement, and you are, but a huge chunk of your savings is being siphoned off to enrich financial institutions. You're running on a treadmill while someone else profits from your effort. Here's what compounds this problem. Most people just set up their 401k and forget about it. They pick the default funds, maybe they check their balance once a year, and then they don't think about it again until retirement. This is the set and forget mentality, and it's exactly what the financial industry wants. If you're not paying attention, you'll never notice the fees, you'll never ask questions, you'll never realize you could be doing better. But your retirement is too important to set and forget. This is literally your future. The difference between retiring at 65 and working until 75 comes down to decisions you make today. And those decisions are hidden in fee structures that almost nobody understands. So what can you actually do about this? First, find out what you're paying. Log into your 401k. Look at each fund you own. Find the expense ratio. Write it down. Do this for every single fund in your plan. Most plans make this information available online, usually in a document called the Fund Prospectus or the Fund Fact Sheet. If you can't find it, call your plan administrator and ask. They have to tell you. Second, look at what options are available in your plan. Most plans offer low-cost index funds alongside expensive actively managed funds. Index funds that track the S&P 500 or the total stock market typically have expense ratios below 0.1%. Some are even lower. If your plan offers these, use them. This is the single most impactful change you can make. Third, educate yourself about what you own. You don't need to become an investment expert, but you should understand whether your money is in actively managed funds, index funds, target date funds, or bond funds. You should know roughly what your overall fee burden is. This takes maybe an hour, and it could save you tens of thousands of dollars. Fourth, if your plan is terrible, advocate for change. Talk to other employees. Request that your employer offer better options. Ask why your plan offers expensive funds with high expense ratios when cheaper alternatives exist. Put pressure on your employer to align their 401k offerings with what's actually good for you. Some employers will listen if enough people ask. Fifth, consider whether a 401k is even the right tool for you. If your employer doesn't match contributions, if your plan is full of expensive funds, if there's no way to improve the situation, then maybe you should max out an individual retirement account instead. You have more control over the fees in an IRA. You can pick your own broker, your own funds, your own fee structure. But here's the catch. Many employers do match 401k contributions. If your employer contributes 50 cents for every dollar you contribute up to 6% of your salary, that's free money. That's an immediate 50% return on your investment. You can't walk away from that, even if the plan is otherwise mediocre. In that case, you contribute enough to get the full match, and then consider contributing the rest to an IRA. The bigger picture here is that the 401k system is broken. It was never designed to be your sole retirement vehicle. It was supposed to be supplementary. But companies shifted away from pensions, and now most people rely entirely on their 401k. The financial industry has captured the entire system, turning it into a mechanism for extracting wealth from workers. You're not going to change the entire financial system by yourself, but you can change what happens with your own money. You can stop being a passive participant in a system designed to benefit everyone except you. You can demand transparency. You can seek out low-cost options. You can pay attention. Remember that 41% of workers who don't know they're paying fees? Don't be one of them. Your retirement is not something to set and forget. It's something to actively manage and protect. The difference between a comfortable retirement and a stressful one might literally come down to whether you spent 1 hour understanding your 401k fees. The financial industry doesn't want you to know this. They want you to feel grateful for the 401k. They want you to think it's a great benefit and leave it alone. But now you know better. You know there are hidden fees. You know those fees can cost you tens of thousands of dollars. And you know you have the power to do something about it. Start today. Check your 401k. Look at your fees. If they're high, make a change. If you're in good shape, great. But verify it. Don't assume. Your future self is counting on the decisions you make right now.